Nigeria's latest dual-tranche Eurobond issuance drew overwhelming investor demand, oversubscribed by over 400%, despite heightened geopolitical tension triggered by U.S. President Donald Trump's threat of military action over alleged killings of Christians in Nigeria. The $2.2 billion offering attracted $9.1 billion in bids, with the 10-year tranche oversubscribed 7 times, and the 20-year tranche also heavily sought after. Analysts say attractive yields, fiscal reforms, and improved credit outlook boosted investor appetite. Paradoxically, the secondary market saw heavy sell-offs earlier in the week as global investors reacted to Trump's comments, pushing average yields on existing Eurobonds to 8.17%. The episode highlights the tension between strong financial fundamentals and political risk sentiment. Now joining us, Oladipo Ajayi, head fixed income, Chapel Hill, Denham Securities. You're welcome to the show.
Good morning. Thank you very much for having me.
All right, so let's get straight into it. We have a situation. On one side, Nigeria's Eurobond prices are sliding after Trump's threat. On another, a new issue has drawn record demand. How do you make sense of this contradiction? What's really driving this love-hate relationship with investors that investors seem to have with Nigeria's bonds?
Well, if you look at it critically, you will notice that at the beginning of the week, we saw that each slide in prices of Eurobonds, and that is premised on the fact that there was a statement by the President of the United States. And it's not only peculiar to the Eurobond, we also saw the impact of that across the capital market. We saw that that also affected the equities market and even the fixed income market. And but what we noticed was at the beginning of the trading section yesterday, we saw the new interest in the Nigerian Eurobond space. And I think that is one premise on the interest that the market suspected around the new issuance. And just like what you have mentioned at the where you actually introducing that topic, was that one thing that I feel actually stand out is the policy of the government. And aside the policy of the government, also we have seen a good ratings on the part of the country. We've seen the Fitch actually upgraded our rating. And aside that as well, don't forget that we have seen in the last 2 months, we have seen 2 rate cuts by the U.S. Fed. When you sum all these together, you expect this to actually have a positive impact, and that's exactly what we saw yesterday.
Invasion rhetoric sent shockwaves through global markets, and it triggered a sell-off in emerging market debt. Now, how much of Nigeria's Eurobond tumble is about Trump's comments, and how much is about broader fears of geopolitical risk?
Well, if you look at it critically, it's minimal because when you look at where market was traded before these comments were made, you will notice that we didn't see much of a slide in prices. What we just saw was more like the initial reaction, and before the end of trading section on Monday, we saw renewed interest from some of the investors. But it may not be as much as what we've seen in the past. If you look at what has been happening in the past weeks in the Nigeria Eurobond space, we've seen aggressive interest, and not only in Nigeria sovereign names. We also saw interest in the corporate names as well. When you look at what has happened on Seplat, Access Pep, you have looked at what ETI and the like. So it simply means that beyond the Trump statement, the Nigeria Eurobond market has been very strong and has been enjoying a lot of patronage. When you start seeing the dovish interest posture of the U.S. Fed actually amplified, of course, you expect to see more funds actually coming to the emerging market to actually look for return. And that's exactly what we have been seeing. We've been seeing a lot of interest coming. But immediately that statement was made, we saw a bit of drop, but nothing significant to assume that it's all doom and gloom.
That there's some strength in the Nigerian market. Now, this oversubscription shows that investors are still eager to learn, even as secondary market prices are falling. Does that mean investors still trust Nigeria's fundamentals, or are they just chasing short-term yields despite warning signs?
Well, I would not say this is short-term yield because when you look at in the month of October, Angola was in the market, and Angola actually issued 5-year and 10-year instruments. This instrument were issued at 9.244 and 9.875 respectively. And when you now compare that with what Nigeria actually cleared their issuance yesterday, of course, it's actually miles apart. So if it's about return, of course, Nigeria would not have been the destination. A lot of people would have gone to other emerging markets. I think it's beyond the alpha, which is more like the return. I think it's more of the fundamental issue around the country. Like I mentioned earlier, Nigeria has actually improved drastically when you look at where we're coming from before now. Last year, Nigeria was in the market. We issued a 10-year bond at 10.125. And we also issued a 7-year bond at 9.625. When you compare between last year, December, and now, that's just like about 11 months. We'll be able to actually come to the market stronger, and we'll be able to come to the market to actually issue at a better rate than where we were before. When you look at the reserve of Nigeria, our reserve has grown aggressively. Currently, the reserve is north of $43 billion. That's also reinforced the fact that foreign guys will also want to look at your market, because it simply means about around your capability to actually repay in the event that you need to pay the coupon or you need to pay for the maturity of the sum of this obligation. And when you look at the Nigeria antecedent, there's not one time that Nigeria has actually defaulted on the obligation. Nigeria has been making good the obligation. And these are some of the things that some of these foreign guys look at when they're actually coming into the space. So for me, I think Nigeria is still very strong. That's one of the reasons why we saw that huge interest in the Eurobond.
All right, still harping on Nigeria's strength, would you say that Nigeria's Eurobond is offering one of the highest yields in the emerging market space? And are investors overlooking political risks because the returns are simply too good to resist?
No, I would not say that, because just yesterday, the Republic of Congo was also in the market. They were also in the market issuing Eurobond. They issue Eurobond at a yield of 13.70, and that is a whopping about 570 basis points above where Nigeria actually cleared his 10-year instrument. So it means that it is beyond the return. Because if it is return, like most investors would have gone to Angola, they would have gone to Republic of Congo, they would have gone to other emerging markets that actually present a better yield than what Nigeria is currently giving now. When you look at all Nigeria instruments, there's none that's actually giving double digit as we speak currently. The best you can get is a little above 9%, and that is when you're actually looking at the long end of the curve. That's when you are looking about around a 27 to 30-year instrument. So it is not about the yield, like I said. It's about the fundamental. A lot of investors are saying that Nigeria have taken a lot of bold decisions. I remember of subsidy, amortizing of exchange rate, and some of the bold policies that the country is currently taking. And these are some of the things that will actually attract some of these foreign investments into Nigeria's space. So it is not about the return only. It's about the fundamental that's actually underlying the return.
All right, so let's bring this conversation towards government intent. Now, the government has pitched this Eurobond as part of a strategy to fund infrastructure and support reforms. Now, does this strong investor appetite validate Nigeria's fiscal credibility or just highlight the global hunger for risk?
Well, I would think it's more of the hunger for return. And you know what I was saying earlier when I mentioned that at the U.S. Fed is currently dovish, and as a result of that, a lot of investment will leave the U.S. where looking for better return. And I think that's one of the things that Nigeria is currently enjoying as well. And beyond that as well, I also think that, like I mentioned, in terms of the policy of the government is also a factor that they're also considering as well. But when you look at in terms of fiscal discipline on the part of the government, I also believe that there's still a lot to be done. And I'm sure the government is also working around this, because beyond actually raising this fund, it's about actually applying it for the reasons why this funds are being raised. The current $2.25 billion that's actually being raised could be attributed to funding the budget deficit. And this has been highlighted to the beginning of the year, that part of the deficit for the budget of 2025, some part of it will actually be sourced externally, and that's exactly what they are doing currently. So the government needs to now take it a notch higher, and they need to be more transparent in the application of some of these funds, because beyond actually raising the funds, they're also you need to also be transparent to the investors around how these funds are judicially applied. And that is one side I feel that the government needs to actually up their game around.
All right. Now, a 400% oversubscription is definitely something that is worth celebrating, which, of course, the Debt Management Office did because it's a proof of investor faith. Now, beyond the headline, what message does this send about how the world views Nigeria's economic story right now?
I think it's simple. I think it's just that Nigeria's economic story is very strong. Because when you have that level of interest of funds coming to your plan, it means that they believe in the story. When you are seeing what was happening in emerging markets in the last years, we saw what happened in Ghana, we saw what happened in Zambia. We noticed that some other emerging markets trying to actually restructure their debt. And when you look at some of these things, you feel that it could actually be a deterrent to some of the investors that may actually want to invest in emerging market. But actually coming out aggressively to actually fund or invest in Nigeria Eurobond tend to actually confirm that most of these guys still believe in Nigerian story. And beyond the Eurobond space as well, I'm sure you have seen a lot of interest also in the equity markets. You have seen how the equity market has grown in the past. You have seen how the yield in the Naira bond has actually dropped from the 22% at the beginning of the year to currently about 15.8%. When you sum all these things together, it tells a story that investors feel that the fundamentals are still very strong, and they feel that there's still a lot of value in the Nigerian environment.
All right, so it's very evident that global investors are quite optimistic. But would you say that that's the same case for local markets? Because it almost seems as though the local market is still, feeling the pressure from the Naira to local bond yields. Now, could this split between foreign and domestic investor sentiment become a problem for Nigeria's economic stability moving forward?
Well, I don't think it's a problem. I think it's more like the diversification that you need in your market. And when you look at what's happening in the equity market, it's more like the initial panic. A lot of foreign investors, some people, they're actually selling down on some of their equities, maybe to actually take their funds out of the country. And some are actually selling that to actually investing in other asset class. So I won't say to tell you that it's totally because of the statement that was made by the President of the United States. But we've seen more like renewed interest on the part of locals as well. A lot of locals, asset managers, they are currently in the market trying to actually shop for return. On the bond side, I don't think the statement actually affected what's happened in the Naira bond space because on Monday we saw the yield surge to 16%. But as I speak to you now, yield is back around 15.7%, and that was where it was trading even pre that statement. So it means that there's a lot of appetite for local instruments. Of course, we'll see what's happening in the equity market, but we still feel that it's more like profit take. We'll likely see refreshed interest in the equity market. A lot of people are looking at valuation currently. I don't also forget that the 10 dividend season is gone. So you may likely see what happened, what's currently happening is more like the trend in the past. But we know that in the month of December and January, we'll likely see more like come back into that market. And also another factor that's also affecting the equity market is the CIG tax issue. The capital gain tax problem has been there. A lot of foreign investors are still here to get the clearance around this. They need to understand how will this apply to them, what will be the impact on them. So while they are waiting for that, a lot of them will likely want to move back to Naira. So that while they are getting clarity on that. So I think on the part of government, we need to come out to explain this thing better, let them have clarity around it so that we can have more inflow of investment that space.
All right, so I'd like to walk the conversation back to Trump's remarks. Now, markets often react sharply to Trump's statements even before any policy action follows. Now, do you think that investors are overreacting to this rhetoric? Or do they genuinely fear a shift in U.S. policy that could hurt emerging markets like Nigeria?
Well, I think it was just it was a reaction to that statement because the policy currently there's none of the United States policy that is detrimental to emerging markets and that could actually affect Nigeria. It's just a statement of the fact that about the geopolitical tension that we're currently talking about. But there's nothing about market oriented information that should actually affect the market. Of course, And when you hear statement like that, you will see the initial panic, and that's exactly what you have expected from anywhere in the world. You've seen when at the Liberation Day, when they announced the tariff, the tariff increase, that was April 1st. You will notice that the global market actually reacted to that. And after some time, the market actually went back to status quo, and apparently some of these names are actually trading at a better level where they were before the announcement. So you expect to see a market reaction when you see, when you hear information like that, but that is not enough to actually cause a long-term effect on the market.
All right, so oversubscription. Now, that looks very impressive on paper, but it doesn't always mean sustainable trust. What do you feel Nigeria needs to do next to turn this one-time investor enthusiasm into lasting confidence?
I think that we need to continue on our policy shift. We need to continue on the implementation of some of the great policies that we are showing out. We need to continue to be more transparent to the international community around the application of our funds. And also, when we talk about the data integrity, that's very key, because when you release information, a lot of foreign investors make decisions based on such data. So the level of data, the level of integrity of your data also will also count a lot. And on the part of the government, so the government needs to be a bit more proactive around a lot of factors. Insecurity is also one of it. Improved infrastructure is also one of it. So government needs to sit up on the responsibility that the general populace has actually bestowed upon them. You don't want to be hearing negative news about Nigeria. A lot of investors, most of these foreign investors that are actually investing in Nigeria, they are living thousands of miles from here. So you don't want to hear negative news around the country where you're actually investing. And a country like Nigeria that is clamoring for FDIs as well, beyond that foreign portfolio investment that actually earns money. You want some foreign direct investment to come into your country. Of course, you need to actually improve in your policy deployment. And also at the same time, you need to ensure safety of the investors. So the government can actually work on some of these things and also capitalize on the existing growth. I think most of these guys will have more or a better trust in our policy and our government.
All right, so let's take a look at the discussion from a more broader standpoint. And now across Africa, other sovereigns are watching Nigeria's experience very closely. A market tumble paired with investor frenzy. Now, what lessons does Nigeria's paradox send to other African economies planning to tap the Eurobond market?
So we know that the market is still wild. Like I mentioned, Angola was in the market in October. Congo was with us in the market yesterday. So it simply means that the market is still very wild open for anyone who wants to actually raise funds to actually improve or develop their economy. So what the message now is that most of these emerging markets will actually want to come to the market at the point like this. And don't also forget that one of the reasons why the market is this soft as well, like I mentioned, beyond the level of standard or the level of gains that Nigeria have enjoyed as a result of policy deployment. It's also the fact that the U.S. environment as well is now currently very dovish. So a lot of investor Israel can actually take advantage of this window. Of course, you still have the window is still wide open because the expectation is that the U.S. Fed will still have to actually cut rates more. If not this year, of course, we expect to see more Q1 next year. So it simply means that the window is still very much open for anyone looking to actually take advantage of the market. The capital is there and looking for where to actually move to. We just need to ensure that we have what it takes to actually attract some of this capital, and that's exactly what Nigeria has done. We are taking a lot of bold steps, and these are some of the things that led to the attraction into our market. So other African countries can also follow suit. Ensure that you actually put your house in the order, and also visit the capital market to actually raise some of these funds.
All right. So Trump's comments reignited debate about U.S. relations with Africa and stirring investor caution towards the continent. Now, how much of Nigeria's Eurobond turbulence is really about perception? Is Africa being unfairly priced for political risk that isn't entirely its own?
Of course, I would not say Africa is unfairly priced because when you look at currently where a U.S. Treasury is currently trading. Now, when you look at like a 20-year U.S. trading Treasury, a 20-year U.S. Treasury is currently trading around 4.7 levels, and when you compare that to where we actually raised from yesterday, about 9.1 levels. And that's close to about 450 basis points from where that is trading. So the spread is enough to actually cover some of these risks, the credit risk, the geopolitical tension risk, and security risk, and every other risk that we feel, the illiquidity risk as well. And these are some of the reasons why in Nigeria, Eurobond would not trade the same price as like a US bonds as well, because considering the fact that there are other risks involved. And some of the things that actually attract some of these guys to our market is that some people are willing to take these risks because they have the risk, they have the return. If you cannot take the risk, but not do that, just invest in the US Treasury, where you know that the risk is minimal. But if you're able to actually take a calculated risk, looking at the fact that you feel that despite what has happened, this country has the capacity to pay. Despite what has happened, you feel that in the short to medium term, you'll see adequate improvement in the capacity or the environmental activity of the country. Of course, that will actually lure some of these guys, and some of them will actually take risk around that. So I feel that this is adequately priced. Anything beyond this is when I would start thinking that I feel that we are actually overblowing issue.
All right, thank you very much. Unfortunately, that's all the time that we have for this particular segment. But thank you so much for your expert opinions on this topic. Oladipo Ajayi, he is the head fixed income Chapel Hill Denham Securities. Thank you so much.